I made over 30% in the stock market in 2023 and crushed the S&P 500. Here are my top 5 investment ideas heading into 2024. By the way, if you're new to my channel, here's a 15-second intro to who I am and what you can expect. I'm Kyle, a former investment advisor, and I started this channel mainly to teach people how to invest. This video is not investment advice. It's a professional lesson on how to spot investment opportunities using real-life examples that I see right now. I don't have a crystal ball, and I'm not right about everything, but in 2023, I brought you opportunities in industrials, US regional banks, utilities, and Indian stocks, all of which were highly profitable. I told you the housing market wouldn't crash, and it didn't. I told you to stay in short-term bonds, and they far outpaced long-term bonds. I told you to avoid the BITO Bitcoin ETF and not to short Nvidia. I nailed every one of those calls. And most importantly, last December when the average forecaster was the most bearish they'd been since 1999, I said,
even if there's some more near-term downside due to China or rates or valuations or whatever, later in the year at some point, the market is likely to shift its focus to an eventual recovery.
And that is exactly what happened. So where does that put us heading into 2024? Here's the backdrop that'll set up all 4 of my investment ideas for 2024. The stock market always prices in what investors expect to happen in the future. However, most investors are usually very short-term oriented and tend to get narrowly focused on one thing. So because of that, you can often spot opportunities if you look a little further ahead and pay attention to what the market is missing now, but will be focused on in the future. So right now, investors are hyper-focused on interest rates and are ignoring everything else. Heading into 2023, everyone expected rising rates to cause a recession. And I said, sure, we might have a recession, but for investment purposes, you want to get ahead of that and think about the recovery because the recession was already priced in. The market got crushed in 2022 because it was pricing in a future recession. And now, 1 year later, heading into 2024, I think it's almost the opposite. We haven't had the recession everyone was expecting, and there are signs of falling inflation. So the market's thinking, awesome, we're totally out of the woods and rates will come down without a recession. Except there's just one problem. The market is ignoring everything else except interest rates. And I think that's leading investors to price in an unrealistically rosy scenario. That's why the market has been up so much lately. It's pricing in the recovery, just like I predicted it would, but we haven't had the downturn yet. So here's what I'm looking at that the market seems to be ignoring. The Conference Board produces a leading economic indicators index of 10 different metrics that predict recessions. In November, it fell for the 20th month in a row, the most since the great financial crisis in 2008, and it's predicting a recession. Now, it's not perfect, but 9 of the 10 leading indicators were either flat or negative in November. Can you guess what was the only one that wasn't? The stock market. So I think it's much more likely that the recession has been delayed than it is that we won't have one. But look, whether we have a technical recession or not is pretty much irrelevant. What I'm actually more interested in is the massive disconnect between what I expect to happen and what the stock market is pricing in. As of December 22nd, the S&P 500 is trading at a forward PE of about 21.4, which is more than 1 standard deviation higher than its 25-year average. Translation, it's expensive. And not only is it expensive based on next year's estimated earnings, but next year's estimated earnings are projected to grow by 11.5%, which is faster than the historical average. So hold on a second. You're telling me that 9 of the 10 leading economic indicators are pointing flat or down, but earnings are gonna grow even faster than usual. And I should pay an even higher price for those earnings. So because of that, I'm gonna go into 2024 with a relatively conservative stance. I'm probably never gonna get completely out of the equity market, but I have been trimming a lot of my positions that have run up a lot in late December. I'd say there's a pretty good chance there will be an equity market correction of at least 10% in 2024. That said, here are 2 quick pieces of wisdom. There are always opportunities to make money in any market environment. You just have to find them. No one is forcing you to buy an S&P 500 ETF. No matter how confident you are in any market call you make, you can always be wrong. So don't put all your eggs in one basket, stay diversified, and ideally, try to find opportunities where there are multiple ways for it to go well, even if your major overarching framework turns out to be wrong. For example, investment idea number 1 for 2024 is the Japanese yen. I brought this idea up in a video in August when I told you I was investing in the 2X yen ETF, YCL. It's basically flat since then, and the thesis is the same. So I won't include all the detail here, but the main point is that the key driver of the yen-dollar exchange rate has been the interest rate differential. It's gotten wider, meaning the returns on safe US Treasury bonds have gotten higher compared to the returns on equally safe Japanese government bonds. Of course, higher potential returns for the same level of risk have led a lot of investors to move money out of Japan and into the US, driving up the dollar. However, over the next 2 to 3 years, I expect US rates to come down a lot more than Japanese rates, which should narrow that interest rate differential and strengthen the yen versus the dollar. Here's the kicker. Remember how I said the market expects rates to come down without a recession? And I think there might still be a recession? Well, either way, US interest rates are coming down, and that should be good for the yen. That's what I mean by looking for opportunities that can work out even if you're wrong. It's certainly not a guarantee. There are things that can go wrong, like if inflation and rates pick back up, but this one gives me multiple ways to win. And that's the kind of investment I like to look for. That brings me to investment idea number 2. Areas benefiting most from the recent optimism that I want to avoid, or at least de-emphasize in my portfolio. These would include the Magnificent 7 and industrials. Here's why the Magnificent 7 scare me right now. Through December 21st, those 7 companies, Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, and Alphabet, have been responsible for 64% of the S&P 500's return this year. Just 7 out of the 500 companies have been responsible for almost 2/3 of its return. I can't say precisely when that'll come to an end, but it will. So while their dominance could continue longer, personally, I wouldn't want to place a large bet on it. And if I owned a lot of those companies individually, or an ETF like QQQ or IWF, that has 40+% of its assets in those 7 companies, I would be reducing those positions on strength. They all benefited from optimism about falling rates. A lot of them benefited from AI optimism, and investors seem to be ignoring risk around Chinese competition, antitrust regulation, and a recession. Remember, a great company isn't always a great stock, and you can't just buy past returns. When it comes to industrials, here's why I'm selling my position in EXI, a global industrials ETF. To understand the thought process, let's start with a 20-second recap of why I owned it in the first place. I brought you this idea in July 2022 as a 10-year opportunity, and nothing about that thesis has really changed. In a nutshell, I said that
2 themes. The green energy transition and reglobalization are going to create massive growth opportunities for all kinds of companies. But industrials are likely going to be some of the biggest beneficiaries.
Since I put out that video, EXI has beaten the S&P 500 by about 7%. And if we want to get technical, EXI is a global ETF, so a more relevant benchmark would be the MSCI ACWI, which it's beaten by over 10%. So far, so good. At this point, the question you should be asking is, if it was a 10-year thesis and nothing has changed, why would you be selling? Well, it goes back to my original framework of trying to think about what the market is missing now, but will be focused on in the future. EXI is up about 20% since late October, in less than 2 months, because basically everything is going right for industrials. People generally don't think we'll have a recession anymore, and construction spending has been skyrocketing because of Biden's stimulus plans. This doesn't even capture it all. Roughly $250 billion of manufacturing investment related to the Inflation Reduction Act and CHIPS Act have been announced over the past year. A lot of that hasn't broken ground yet, but it is reflected in the stock prices. At this point, a lot of these companies are about as expensive as they've been relative to the overall stock market in decades. They do have new growth opportunities, like I mentioned, so some that could be justified, but valuations like that leave investments vulnerable to a sell-off if any little thing goes wrong. Like, what if a Republican gets elected and reverses some of Biden's spending plans? Or what if we have an economic downturn like 9 of the 10 leading indicators are suggesting? That's not good for airlines, railroads, shipping companies, or basically any industrials. I think there's a lot that can go wrong, and valuations are at a point where a lot has to go right in order to justify them. So even though I think they still have good long-term potential, I've decided to sell while the market seems overly optimistic and look for a better opportunity to get back in. Ideas number 3 and number 4 are pockets of opportunity that I see within a generally expensive market. Like I said earlier, no one is being forced to buy an S&P 500 ETF. My third investment idea heading into 2024 is mining companies, and I'll be replacing my position in EXI with MXI, a global materials ETF. Materials is the name of the sector that mining companies fall under. Many mining companies benefit from the same themes that led me to invest in industrial companies. Think about it. With all this new infrastructure they're going to build, industrials will often be the ones to build it. But what would they build it with? Materials from the materials companies. In a lot of cases, that means more industrial gases or metals like copper, lithium, iron, and so on. However, unlike industrials, mining companies are about as cheap as they've been compared to the overall market in the past 60 years, with the exception of the pandemic. Why such a big valuation gap when they benefit from the same theme? Well, one of the key reasons is that collectively, these companies get roughly half their business from China, and China's economy has been extremely weak this year. Not only that, China's weakness has been centered around a downturn in their housing market, which is where a lot of the demand for those materials comes from. If we go back to February 1st, which is right around when the China recovery optimism started to fade, you can see that MXI, the red line, has been essentially flat, and it's underperformed industrials and global stocks by over 10%. What I like about MXI is that it gives me an indirect way to invest in China's recovery. It gives me exposure to similar themes that I got from industrials ETF, EXI, and it's trading at historically cheap levels relative to the market. Could this be at risk if we have a recession or if China's economy gets weaker? for sure. But its cheap starting point, long-term attractiveness, and indirect exposure to a China rebound make it attractive to me on many levels. That brings us to my number one investment idea for 2024, healthcare. Healthcare stocks are attractive to me for 3 reasons. I expect an economic downturn, and a lot of them tend to be defensive, aka they usually hold up well in economic downturns. Second, with all this, actually, we're not gonna have a recession. Optimism, healthcare stocks have been left in the dust this year, almost 20% behind the global stock market. And don't even get me started with the Magnificent 7 stocks that I mentioned earlier. All 7 of them are up at least 50% this year, with Tesla up around 100%, and Meta and Nvidia up more like 200%. At this point, healthcare companies are about as cheap relative to tech companies as they've been at any point in the last 70 years. The third reason I like healthcare companies right now is that there's a pocket of high growth opportunity in small cap biotech companies that have been getting crushed under these new high interest rates. I also think part of the story is that as the pandemic faded away, a lot of the optimism around healthcare innovation faded away with it. Investors had almost certainly gotten a little ahead of themselves back then, but now I think it's swung too far in the other direction. XBI is an equal weighted US biotech ETF, and equal weighted means it's got a lot of small caps and mid caps in there, more than any other ETF I could find for this example. Since the end of January 2021, XBI has trailed the S&P 500 by over 76%. A lot of these companies are trading at valuations we haven't seen since the depths of the financial crisis. And that means there are 2 clear avenues for them to do great over the next couple of years. 1, they can recover to a higher valuation as interest rates come down. Or 2, they can be bought out by larger companies since they're cheap right now. I think both of those things will happen over the next few years. So to sum it up, the healthcare sector has defensive characteristics and growth characteristics, and it's trading at ridiculously low valuations. And it can do well regardless of whether I'm right about a coming recession. That's why healthcare is my number one investment idea heading into 2024. As far as how to tackle it, my preferred method is to invest in Vanguard Healthcare, ticker VGHCX. I like it because it gives you global exposure, which is important when a lot of the best pharmaceutical companies are outside the US. It's actively managed by a legendary healthcare investor, Gene Hines, and it has a tiny 0.34% expense ratio. And by the way, to all of you who think active managers can't beat passive managers, here's how Gene has done against the passively managed iShares Global Healthcare ETF since she took over in 2008. The actively managed Vanguard fund is ahead by over 100% since then. I would say that's a healthy excess return. So let's recap my top 4 investment ideas for 2024. I want to own the Japanese yen because I believe US interest rates versus Japanese interest rate differentials will narrow, strengthening the yen. I want to reduce my exposure to the Magnificent 7 and industrials, which I think have been benefiting from significant optimism and now are priced for perfection. I want to own more materials companies because they benefit from similar long-term tailwinds as industrials, but they're much cheaper. And they have the added benefit of indirect exposure to a potential Chinese recovery. And most of all, I want to own healthcare companies because they're cheap, unloved, defensive, have respectable growth potential, and can do well even if I'm wrong about the coming recession. Of course, I'll keep you posted if I change my mind on any of these things, and I'll be sure to bring new ideas as they come to me throughout the year. So hit that subscribe button and let me know in the comments if you have any questions. And if you want to communicate directly with me, check out the link below to my free Discord. Stay tuned for my 2024 housing market video and 2024 bond market video.